Welcome back to Beyond Yield. Thank you so much for joining us again and for being a part of the Beyond Yield family. Here on Beyond Yield, we cut through the noise, we focus on data, trends, and numbers that actually matter, so you can understand what's really happening beneath the headlines. And today we are breaking down something that sounds complex but is actually very simple: bonds. You have probably heard words like coupon, tenure, or maturity date and thought, okay, this sounds technical. But once you connect it to real life, it becomes very clear. Let's simplify it. Imagine your apartment association wants to install solar panels on the building's rooftop. Instead of taking a bank loan, the association decides to raise money from residents. They say, if you contribute rupees 50,000, we will pay you rupees 5,000 every year. And after 5 years, we will return you rupees 50,000. You agree. What just happened? You gave money, you will receive a fixed yearly income, and your original amount will be returned later. That is exactly how a bond works. In real life, instead of a housing association, the borrower is usually the government, a company, or a public authority. Instead of a verbal agreement, everything is legally documented. A bond is simply a structured loan between you, the investor, and the issuer. Now let's understand the three important parts of that structure. Let's go back to the apartment example. You contributed rupees 50,000, you receive rupees 5,000 every year. That yearly payment has a technical name. It's called the coupon. Now let's apply this to a company issuing bonds. A manufacturing company wants to expand its factory operations. Instead of borrowing from a bank, the company announces, we are issuing 5-year bonds at 10% to fund our expansion. Now what does that mean? If you invest rupees 10,000 in this bond, 10% of rupees 10,000 equals to rupees 1,000. You will receive rupees 1,000 every year. That 10% is called the coupon rate. So when a company issues bonds at 10%, the coupon is the fixed interest paid every year on the original investment amount, also called the face value. Payments may come monthly, quarterly, half-yearly, or annually. But the key point is this: the coupon is fixed. Even if market interest rates go up or down, your rupees 1,000 per year remains the same. Now imagine the association says, we will return your money in 3 years, or we will return it in 10 years. The time period your money remains invested is called tenure. In the same way, when a company issues a bond and says, we are issuing a 5-year bond at 10%, that 5 years is the tenure. During these 5 years, you receive rupees 1,000 every year. The company uses your capital for expansion. Tenure simply means how long does your money stay invested. It could be 1 year, short term, 2 to 5 years, medium term, 10 to 30 years, long term. Shorter tenure, money comes back sooner. Longer tenure, money stays invested longer, often with slightly higher interest. It's simply the time commitment. Let's continue with the company issuing bonds. You invested rupees 10,000 in the company's bond, you receive rupees 1,000 every year. 5 years pass. At the end of the 5th year, the company returns your original rupees 10,000. That final repayment date is called the maturity date. So coupon equals to rupees 1,000 per year, tenure equals to 5 years, maturity equals to end of the 5th year when rupees 10,000 is repaid. Until maturity, you earn the coupon. At maturity, you receive your principal back. That's the simple structure of a bond. Now comes the most important concept, yield to maturity, or YTM. So far, everything sounded simple. But here is the twist. Bonds don't just sit quietly in your drawer until maturity. They're bought and sold in the market every single day, and their price keeps changing. Let us take the same manufacturing company that issued a 5-year bond at 10% to understand the yield to maturity. If you invested rupees 10,000, coupon equals to rupees 1,000 per year, If you buy it at rupees 10,000 and hold it until maturity, your return is clearly 10% per year. But what if market interest rates change? This is where yield to maturity or YTM comes in. Let's look at two scenarios. Scenario 1, new bonds offer higher interest. Your bond becomes less attractive. Suppose after 1 year, market interest rates rise. Now the company issues new bonds at 11%. Your bond still pays 10%. Investors prefer the new 11% bonds. If you want to sell your bond, you may have to sell it at a discount, say rupees 9,500. Now the new buyer pays rupees 9,500, receives rupees 1,000 per year, receives rupees 10,000 at maturity. Since they bought it at a lower price, but still receive the same rupees 1,000 annually and rupees 10,000 at maturity, their actual return is more than 10%. That higher effective return is called yield to maturity. When the bond price goes down, YTM goes up. Scenario 2. New bonds offer lower interest. Your bond becomes more attractive. Now let's reverse the situation. Suppose market interest rates fall. The company now issues new bonds at 8%, but you own a bond paying 10%. Now your bond looks more attractive. Investors may be willing to buy your bond at a premium, say rupees 10,500. Now the new buyer pays rupees 10,500, still receives rupees 1,000 per year, receives rupees 10,000 at maturity. Notice something important. They paid rupees 10,500 but will receive only rupees 10,000 at maturity. So they effectively lose rupees 500 at the end. Even though they receive rupees 1,000 annually, because they paid more than the face value, their total return becomes less than 10%. That reduced effective return is their yield to maturity. When bond price goes up, YTM goes down. Here is the simple rule. When market interest rates fall, bond prices rise and the yield to maturity falls. When market interest rates rise, bond prices fall and the yield to maturity rises. Coupon stays fixed at 10%, yield to maturity adjusts based on the market price. Yield to maturity is the total annual return you will earn if you buy the bond at its current market price and hold it until maturity. It includes all coupon payments, any gain or loss between the purchase price and the face value, the time remaining until maturity. It gives you the true return, not just the stated coupon. Let's quickly understand the main types of bonds you'll hear about. Firstly, government bonds, issued by the government to fund public spending, considered safer, backed by government, fixed interest payments, available in different durations, often preferred by conservative investors. Secondly, corporate bonds, issued by companies, usually offer higher interest than government bonds, slightly higher risk. Rated by credit agencies, higher return usually reflects higher risk. Treasury bills, T-bills, short-term government instruments, you don't receive periodic interest. Example, you buy at rupees 98, you receive rupees 100 at maturity, your profit is 2 rupees. Zero coupon bonds, no regular interest payments, you buy at a discount and receive full value at maturity. Floating rate bonds, interest rate changes based on market conditions. If rates rise, your returns may increase. Sovereign gold bonds, government-backed bonds linked to gold prices. No need to store physical gold, fixed interest income, potential gain if gold prices rise. Bonds are generally stable but not risk-free. Key risks include interest rate risk, rising rates reduce bond prices, liquidity risk, selling before maturity may result in a different price. Default risk, some issuers may struggle to repay. The basic rule is higher return usually means higher risk. Think of a bond like contributing to a structured project. Coupon equals to your yearly income. Tenure equals to how long your money stays invested. Maturity equals to when your original amount is returned. Simple, predictable, structured. Today we simplified bonds. A bond is simply a structured loan you give it to a government or a company. Coupon means the income you receive. Tenure means the duration. Maturity means the repayment date. Once you understand these three terms, bonds stop sounding complicated. If this episode made finance simpler for you, share it with someone who still finds bonds confusing. See you in the next episode. Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risk, including delay and/or default in payment. Read all the offer-related documents carefully.